I'm going to try to do three things today that I think maybe we haven't seen so much before. One is certainly going to try to keep you awake and do something that, that doesn't look very good. Let's go back. There we go. I'm going to try to present facts. I promise you there'll be no slides with pictures of clouds and one word that says, you know, transparency, or pane of glass that says transparency. None of that. And I'll try to do this very, very quickly, way too quickly. Please do not try to take notes. Please, whoever's talking, shh, shh. Please do not try to capture this. I'll put on my email address at the end, and I'll send you a copy of the presentation. That's fine. I'd prefer to do that than you download it for our compliance purposes. But can we get this on this screen as well, by the way? I'm going to need this here. There's going to be about 400 animations and about 5,000 words in this presentation, so you're not going to get all of it. You'll get a few things, and hopefully they'll sort of come in by osmosis. If I can't get this here, I'm going to have to do this sort of standing off to the side. But OK. So Vincent asked me to do two things. One is to demystify the notion of what's going on in the financial markets. Anybody here want to say that they understand the financial markets? You'd be sitting on a desert island somewhere, luxuriating, as opposed to at this conference. The other thing is to talk about the way in which the digital ad market works, really works, and in our view is somewhat rigged. So about my company very quickly, I founded it in 2000 as a, I left one of the leading investment banks. Can one of you, your guy, come and try to get this here so that way I don't have to sort of. I have someone else's presentation here. Anyhow, I left a big investment bank to do Arete with three principles: exclusivity, integrity, and excellence. What does that mean? Those are these kind of words you put up on slides. What does it really mean? It means we don't take money from companies. We don't get paid to say things. Very simple. Exclusivity, we have about 30+ staff. We help the top 150 investors understand what they're actually investing in. Crazy idea that they would do that, but we do that. And we see about 200 companies a month as a team. We go out all over the world. We do global research in telco, cable, media, internet, semis, software, et cetera. Our job is not to be the dog humping the tree, or we're trying to not examine the bark, as you see far too often, but step back and look at what's really going on. And unlike the banks and the industry analysts, the industry analysts, if you pay them enough money, they'll say nice things. If you want to be in the top right-hand quadrant at Gartner, you just have to buy more consulting services. The investment banks, it's can you see if you can fix that? That'd be great. The investment banks, they have buy ratings on 70–80% of the stocks, even though half the stocks in the market underperform. Explain that one. We're there to point out the elephants in the room. So let's talk about be wearing the cheerleaders. This is what's going on in the market. Percentage of unprofitable IPOs. As you can see, we're back to the levels we saw in the last bubble. There is a brand of cigarettes in the UK called Death Cigarettes. Their slogan is, if you want to kill yourself, great. We'll help you do that and make a profit from it as well. That's what's going on with these unprofitable IPOs. We can talk about whether that's a bubble. Everybody know this lady, queen of the internet, Mary Meeker? How many of you heard her say that people look at their smartphone 150 times a day? How many of you heard that? Trouble is she made it up. No basis in fact whatsoever, right? She said her data had been public. There was no fact, nothing could be used to back up that 150 times a day claim. Morgan Stanley, the firm she used to work for, said in the first year, oh, fantastic, look at that. In the first year of the Apple Watch, there'd be $17.5 billion of sales. Boy, was that wrong. What you're seeing is, this is PR. It is not there to give you a dispassionate view of the market. It's designed to sell stuff. The VC industry, we regard it as something sort of slightly gussied up version of pimping. They're there to exploit young and vulnerable companies. And look at that. Is that me or is that you? OK, so this is what's going on. You have companies that just want to get a 400% IRR in 6 months. The VCs, and introduce you to the networks of their friends, accountants, and lawyers, and so forth. What that's fed is, I'll use both of them at the same time. I'm going to do this two-handed. Watch this. There's still half a trillion dollars of cash on balance sheets out there, burning holes in pockets of big companies like Facebook, Google, and others. I'm really confused. Which one is working? Oh, this one seems to be working. OK, great. And this is the increasingly crowded unicorn club. This is simply a reflection of asset bubbles everywhere in the market. This is nothing that you should take it as read, that if you have a clever idea in a startup and 12 of your friends who are very smart, that you can also somehow generate a valuation that's really worth $1 billion. The number of VC-backed tech unicorns and VC-backed tech exits, as you can see, is plunging downwards because it's getting a lot harder to sell this sort of snake oil ideas to people. And my point here is simple. There's a lot of market commentary out there that's presented as fact. It's really self-interested promotion. Let me give you some examples of that. How many people have heard of this company called Roku, just IPO'd? Did you read the S1? If you read the S1, it tells you, we've never made money and we may never make money. First risk factor in the S1. How many investors read that? Probably not enough. Roku shot up. First day, you shouldn't look at that necessarily as an indication of where the stock will trade long term, because that's a fact that the IPO gets hyped up and they sell a very small portion of the company. I mean, read this. We have incurred operating losses in the past and expect to incur operating losses in the future and may never achieve profitability. This is the Blue Apron and Snap IPOs, and unless you were one of the lucky ones that got the stock on the first day, you've lost either 38 or 48% of your money. This is a rinse, lather, repeat sort of process for the markets, because they need these companies coming to the market all the time to make the fees on the IPOs. Netflix, everybody knows Netflix. It's funny, it's a band called Ash. I wish it was called Cash because it would work better. And they did a song called Burn, Baby, Burn. This is Reed Hastings. What he says, look, the irony is the faster that we grow and the faster we grow our owned originals, the more we're going to burn free cash. He's basically saying to the market, our free cash flow burn is a virtue. The more cash we burn, the better our business is. Let's not worry about the fact that we may not be properly, on a GAAP basis, profitable until sometime well into the next decade. And they're getting away with it right now because that's reflective of the asset bubbles that we're seeing in the market. So cash burn, in our view, is nothing to celebrate. What you're seeing is a lot of short-term news, a lot of press releases that come out that sway long-term valuations. And you have to be very, very cautious when you deal with that sort of stuff. Okay, let's take another thing. I know there was the fellow from Oath who talked about storytelling. Look, stories are very hard to value. We all know that, right? Whether it's from Hollywood movies or to 1-second viewability ads. You really, well, maybe in some Asian places you can eat eyeballs, but generally you can't eat eyeballs. They're fish eyeballs, don't worry. Twitter, I think, is a fantastic example of a company that has a huge global brand and doesn't make money. And we were, in November 14, when Twitter had its Capital Markets Day, the stock was $50. There were 42 analysts covering the stock. There was one sell rating, and that was us. We were the only people saying, hang on a second, Emperor's New Clothes, these guys are buck naked, and they're going to be naked for a long time. They don't make money. And what happened, Twitter stock went from 50 down to a low of about 13 bucks. Oh, and by the way, there's the management team. The 14 executives that presented at November 14th Capital Markets Day, one was left by the end of the 2 years. And I think what we all forget is that, and this is Facebook, I think, is an interesting, good example, but these are all very young companies. There aren't the Rolls-Royces and the Westinghouses and the Motorola's, the Six Sigma, the GEs of the world that are the management universities in this industry. It's a very young industry, and a lot of companies, frankly, are winging it. And it's not that hard for guys like us, when we meet these companies, to realize that that's what's happening. I won't mention Snap in that context. By the way, kids on Wall Street, they love shiny new toys. Credit Suisse in 2013 told you that the wearables market was going to be $50 billion by last year. That missed a little bit, but that's okay because it allowed them to float GoPro and Fitbit. GoPro it was an interesting one because it went from a $100 stock price down to $3. And look, when I really get vomit-inducing is when I hear stuff around, ad tech. Let's face it. We've been looking at ad tech now for about 5 years. The vast majority of ad tech companies out there are arbitrage businesses. Arbitrage businesses almost never last, right? They're taking a spread, and when that spread gets understood and found out, like Rocket Fuel, which IPO'd, was, of course, on the conviction list at Goldman Sachs, a $60 stock. People looked at a 60% take rate, and they said, well, maybe your AI is good, but not that good. And the stock got sold, I think they got sold, taken private at $2 or something like that. And programmatic. I told the Freewheel guy, he was saying, I can't mention programmatic because I told him I'm going to vomit if you do. Programmatic is just automation. It's just a fancy word that was used to float a lot of companies in 2013, 2014. It's nothing more than automation. So let's talk about some of the false flags out there. One is, let's go back a second, the raining deals right now, sort of cloudy with a chance of meatballs. What you see is you see all of these companies, and with the exception of maybe Salesforce and Adobe, they have one thing in common. They're not growing at all. So what are they doing? They're buying everything they can in ad tech. Salesforce bought Crux, Oracle bought Datalogix, BlueKai, and Moat. Accenture's bought 8 agencies. Adobe bought TubeMogul, and so forth. They're all trying to capture the shift in spend from the CIO, who they've been getting money from for ages, to the CMO. And that's why these companies are all reinventing themselves as ad tech and MarTech companies. Telcos and innovation. OK, we've got our friends from Oath, which have all these brands that they showed us at DMExco, Singtel and Telenor. When was the last time you got something innovative from a telco? Next question. So you've got this ad tech space. And again, these are arbitrage trading pit businesses, right? The trading pit may be invisible. It may be on some nebulous exchange. It may be on Scott's bid switch over there, But it's somewhere that no arbitrage lasts forever. Fourth, programmatic, it's not some sort of robot apocalypse or robot nirvana. It's not the idea that you're just going to, all of a sudden you stick things into some black box and everything is better for you. I think what people have learned in the last couple of years with painful consequences is that it's a good way to waste a lot of money. This one, boy. This chart, how many people have seen this chart or some variant of it? Nothing, and this buzzword jungle, nothing has been responsible for more outright value destruction than this Lumascape. It has created a huge amount of market confusion. It has led investors to believe that this space would be an endless supply of fabulously profitable companies, very few of which ever actually made money. And it was basically a disaster for most of the VCs, which is why they were pushing these companies out the door in 2013, 14 as quick as they could. And lastly, the numbers in this market. How many of you look at the IAB digital advertising numbers? Yep, complete garbage. Can't trust them whatsoever. 3 major issues, okay? Number 1, self-reporting by private companies. I don't have to ask every guy in the room when you ask him self-reporting by, what you might say, right? Okay, Second, complete unwillingness to recognize the difference between gross and net. Everybody here know the difference between gross and net? You can get 100 gross. If you're Marin Software, you do $7 billion of business, which is actually your December numbers times 12. But the net of the business is 80 million bucks. Right? Big difference, gross v net. Third problem, the waterfall. Money changes hands. The money that goes in at one end can be reported by 3, 4 different companies by the time it comes out at the other end. So the numbers you're seeing, and so we talked to the IAB, they said talk to PwC, they do our stuff. Let's not talk about PwC and its accounting side and the number of scandals that are in there. Let's talk to PwC about our methodology. And they told us this is how we do it. We ring companies up, say, what's your revenue? They don't ask them gross v net. They don't ask them, can we see that audited? They just ask them and they add it all up. Those are the numbers we see in the market. And of course, no one wants to go back and restate their numbers. Ask ComScore. They're doing that. And measurement, attribution, fraud, these are all hot topics. My point here, and this is the end of the bit about the cheerleaders in the market, now we'll talk about how the markets are rigged, is that this all suits M&A bankers and consultants. It really doesn't suit advertisers. It doesn't suit consumers. It doesn't suit most of the people in the room who are just trying to get to the facts. And when we see presentations without any facts but a lot of glowing slides, we kind of get very nervous. So by the way, this is the last bit of the financial markets. This is, I got one of these in the mail not so long ago, earlier this year. We're trying to raise $2 million for chimp food. Yep, that's right. Animals eat the ultimate diet. They don't get sick. So could you please give me $2 million? And this isn't juice. This is going to be the future of how we eat. OK. So on to digital empires. We've spent a lot of time, most of our time, looking at whether it's Tencent, Alibaba, Baidu, et cetera, in China, Facebook, Google, Amazon, et cetera, here, looking at these sort of digital empires, understanding the contours of them, understanding how other companies can compete or work with them, and how they might rig the markets. So we look at these. They're not exactly benevolent dictators, but let's go through what the characteristics are. First of all, these companies have a ton of cash. They tend to sit on somewhere between $30 and $50 billion profit pools. Second is, most of their businesses involve getting or collecting a toll and having some sort of toll booth business or arbitrage business at the heart of their operations. Third is, they make the law. Every single one of you in this room has signed something that we call the Data Donation Agreement. I am going to donate all of my data to one of these digital empires. Don't look at me stony-faced like, oh, we didn't sign that. Yes, you did. How many people have actually read the terms and conditions of an EULA end-user license agreement for one of the, well, there's a couple people that have. This strange guy over here, yeah, he's read it. He's so proud. Great. You are the one. Yes, congratulations. You know how your data is being used. We're all going to supposedly understand this better with the Euro GDPR. Let's see. But these companies have the ability to effectively get, at scale, billions of people to donate their data to them. And a lot of apps are basically just trying to sneakily collect personally identifiable or location data from their users, whether you like it or know it or not. And obviously empires, if you go back to the French Situationists, they like to control what's seen. And clearly we're all here, and I'm here to learn from this in this conference about how that's working with video. I think Lego, it's a brilliant example with Lego. At one point they had so many product videos and they were doing them in so many languages they just stopped doing the languages. So you get a new product video, when Lego launches a new product, they just give the video with no sound. Every 7 to 8, 10-year-old, or 6 to 10-year-old or 12-year-old kid in the world understands how that thing fits together. They don't need the language description for it. And lastly, they dominate mind share in this sort of, Franz mesmerizing kind of way. Look, the fact is that these platforms have incredible power because they scale globally, like Coke or McDonald's. Where else is Taylor Swift going to reach 100 million people but on Facebook or on Instagram? Where else could Adele get 2 billion video views but on YouTube? So this is why the platforms have this power, but let's make no mistake. These are the vampire squids of web data. It's kind of funny and it's kind of not. So some people are laughing, some people aren't, but you have to look at it in the same way as you look at the tax on the economy from the banking sector, the finance sector. And the measure of market value, what we deal with every day, is the amount of cash and the amount of market cap that these companies have added. Surprisingly, for all the press that Amazon gets, its stock has, this is a trick question, actually eBay has performed better than Amazon as a stock in the last 12 months. You would never guess it. eBay is sort of this boring little business that no one thinks about. Everybody assumes it's used goods and auctions when actually most of it is fixed price and new goods. And it's actually performed better than Amazon because people are slowly cottoning on to the view that Amazon actually doesn't generate a lot, or doesn't generate any cash really. But they add a heck of a lot of sales. And this is the sales base and increase in market cap and 2-year stock price performance of these companies. And they do face pressures. I think one of the biggest issues they face, or one of the checks on their businesses right now is for further expansion or M&A, is the fear of regulation. We'll talk about that in a second. But they're also investing unprecedented amount of money in tech. If you strip out the content cost spend of Amazon, there's about $40 billion of R&D being spent by Apple, Google, Facebook, and Amazon right now. I mean, it's a tremendous, tremendous arms race. And for a lot of the small companies there, it's a question of whether you want to get absorbed into one of these empires, whether you call them evil or not is up to you. And these are the new walled gardens. I won't go through the details of the financials. We include the Chinese as one big group there. They have a tacit or implicit regulation, and they're in a way quasi-state-owned enterprises because of the way in which the state influences their businesses. And these guys are obviously throwing hooks out there everywhere they can, or doing wonderful for the world projects like Internet.org at Facebook. Now, I think it's very important to understand the way in which Google, for example, controls the publishing community. We call the $20.7 billion of traffic acquisition costs that Google has every year Omerta code of silence money. If the publishers want to mouth off about Google, we'll pull that money out. As long as you keep quiet, keep shum, don't say anything, we'll funnel that revenue through to you, and by the way, we'll take a look at the data on the way there. So, the walled gardens capture and aggregate the audiences, and publishers are simply, and it was very interesting comments on the panel there, they're beholden to, and most of these guys said, look, we're not going to chuck our Google business out. We have to work with them. It's just too important a conduit for our revenues. This is something that I think is a critical analogy to understand and will help you understand the way in which the market is rigged, because we're looking at it from a financial markets lens. So in a typical market, you have an exchange, like the stock exchange. You have market makers, which offer a bid and offer spread, either banks or interdealer brokers. Brokers, which are the people who sell you stocks individually, and the stocks themselves. Imagine if JP Morgan owned the New York Stock Exchange. If they were the sole market maker on the stock exchange, so the only one that could decide what the bid and offer spread is, they were also the broker that was suggesting to buy one or another stock, including their own. So if you look at ADX, double-click Bid Manager, double-click for publishers, YouTube, search, maps, etc., that's effectively the system that Google has set up. In the stock market, you wouldn't dream of trading for more than about 10 to 20 basis points. In the case of Google, paying all those things in the chain, you might end up paying 50, even 60%. Google just simply owns the pool of liquidity on its own properties, and it's supplemented by third-party sites. In no market in the world would you allow a market maker to make a market in their own stock, especially not exclusively. Because the temptation when you control the bid-offer spread, well, it'd be simple. You'd have a very high bid and a very low, a very low bid, very high offer, either one. They're seeing both sides of the trade, and they're also seeing all the people who want to make that trade. In the financial markets, this would not stand. This is the way the advertising market is organized. I'm just telling you this so that you understand this properly, because the language is not used in this room that applies to this space. And the fact that DoubleClick is the exclusive broker of YouTube inventory. It's like saying, if I want to buy JP Morgan stock, I can only buy it through JP Morgan. And if my Merrill Lynch broker wants to sell me YouTube stock, he has to pay something to JP Morgan along the way. And that just wouldn't work in the financial markets. It wouldn't be allowed. This system would be seen as rigged or somehow improper. And I don't want to insult anyone. I mean, this is a brilliant business model. Don't get me wrong. This is why Google will generate roughly $36, $37 billion of operating cash flow this year. This is the way the model works, as we understand it. And I'm not sort of trying to insult Google. I mean, this is allowable right now, and I don't see an easy way for this to get broken or undermined. Now, if you look at TV and video, I'm sorry for our friend in Group M is not here right now because we can talk about this in more detail. But clearly there's a shift going on from TV to digital. Clearly that changes the thinking in terms of buying audiences from measuring audience, and we have a relatively negative view of some of the measurement companies out there, to finding really targeted audiences. And the fact is, in the past, the TV spend was mostly allocated via the agencies. They were doing the art of media planning. What they were really doing is running giant arbitrage businesses. Inside most of the big investment banks, you'll see the senior guys are traders, because they're the ones that in good times can make outsized gains. And inside most of the big agencies, at the heart of it, you'll see a Xaxis or a Vivaki or a Cadron. You'll see trading desks, because that trading profit is irresistible. But clearly, as the audience shifts, and we'll talk about those guys in a second, as the audience shifts and people are spending less and less time watching that traditional TV that's funneled through the agencies and more to digital, this is why you see a WPP profit warning in the stock down 25% from its peak. And clearly, you can also see that those returning series ratings are not happening anymore in the same way. The audiences are shifting elsewhere. And everybody is going after this sort of great white whale of TV spend. We see that. Clearly, Facebook and Google are targeting it as well. And it's going to be very interesting to see if the agencies can fight a rearguard action from letting that slip out of its hands. The more complex and the more fragmented the audience is, the more it benefits aggregators or people sitting on what we call the sort of billion user data sets. And again, we'll see how GDPR gets implemented in Europe, because that's one of the few checks there. Now, there's no shortage of backlash against the digital empires, whether you see it from advertisers getting together, whether you see constant articles by Rana Fukar in the Financial Times about how tech titans are too powerful, et cetera, et cetera. The New York Times, how Google took over the classroom. I mean, the publishers hate these guys. It was absurd that Donald Trump's talked about collusion between the New York Times and Facebook. I mean, ask the New York Times how they feel about instant articles and all the revenue they've made from it, the zero revenue they've made from it. They're not in collusion by any means. And clearly, whether it's from News Corp or from Margaret Verstager, I mean, that anti-Google sentiment is coming from all sides. And it was interesting, by the way, the ISIS video stuff, the YouTube funding ISIS, came out just before Ad Week in the Times and the Wall Street Journal, owned by who? We all know this is Rupert Murdoch's long-standing quest against Google. And these companies have enemies on both sides of the fence where they've disintermediated traditional publishing models. They've obviously paid big fines. There was another fine for Amazon today. And I don't want to say here that oh, they've won and it's all over. There are constant companies trying to undermine, or sort of sappers digging under the castle walls. Plenty of companies trying to undermine or expose what's going on inside the Googles and the Facebooks of the world. And you shouldn't believe the hype. I mean, most of these companies, as you know, because you deal with them, they are deeply dysfunctional, often deeply dysfunctional, and they're highly political. And clearly spending a crap ton of money, I was about to say something else, doesn't guarantee success. Microsoft spent $12 billion on R&D last year. Anybody feel that Microsoft is the most innovative company in your life? No hands. Regulatory actions, they move very slowly. There is some rethinking that's going on right now about the definition of antitrust, which is very slippery because it's about consumer harm, and how can you say you're being harmed when you get free services from Google and Facebook? But that's going to take some time. So just to sum up, what did I say? And then hopefully the other difference, the third difference I haven't told you yet we're going to have is hopefully with questions. This is my Campbell's soup can analogy with all the ad tech companies. So number one, don't trust financial market commentary. Don't believe the bubbleheads on CNBC or Bloomberg. They are full of conflicts of interest. They are trying to sell you stories. And don't believe that cash burn is a virtue. Reed Hastings may talk about his debt to market cap. His market cap can go down 20% in a day if they miss numbers, but the debt still stays the same. And stories really are no substitute for strategy. Point number two, the reality is one of digital empires. I mean, it doesn't make my job any more interesting or less interesting. We just have to deal with it. No digital empire, I used to have a slide up that said open is a four-letter word. They don't want open anything. Data for them is probably a bit of a four-letter word. The aim is to own both sides of the trade as much as possible. And regulation, it could take years to unfold, so please don't hang your hat on GDPR being some panacea for anybody. And the third point, the shift from TV to digital video, we see a lot of disarray here in the same way as the publishing model in the digital world. Connected TVs, .coms, and broadcasters, these are tiny markets for the moment. There's a risk also that wasn't discussed at all on the first panel of the fact of viewership going to places where there are no ads, Netflix, Amazon Prime, et cetera. That may be good for the other places where you can place ads, but that's something that I didn't hear mentioned once. So this is a super dynamic, interesting time in tech. We're seeing a lot of land grab behavior. We're seeing record levels of nonsense thrown out there to justify what companies are doing or to deflect attention from what they are really doing. And these bubbles, as you know, never really last. If you want to copy the presentation, there's my email address, and hopefully we can spark some questions. Well, no, this is reality as opposed to I didn't put up a slide of a little boy looking at the sky.
So, what's your manifesto for change? Speak to the media owners in the room, and what should they do?
That's a great question in terms of what can change. I think there's a lot of companies that talk about transparency, but obviously don't really want it. Media companies and internet companies aside. I think there is an immediate, huge efficiency savings on the part of advertisers just by properly looking and seeing how much money they've wasted with fraud and poor viewability. I mean, let's face it, a 1 or a 3 second standard for seeing anything, it's meaningless. It's blink and you're gone. And how you've allowed these least common denominator systems to evolve is kind of beyond me. my concern with some of the media owners and how they're working is when you see, whether it's Pangea or eMetro, all the various agglomerations of publishers. Hearst tried it in the States, getting all these folks in a room together to agree to share data and to go after one or two small common wins or common goals is very difficult, because they all have their own egos and overlapping agendas, and they need to get on the same page in what they're trying to accomplish. I mean, I think there's no doubt that the audiences on the FT and the Economist and the Guardian that would feed into Pangea would be immensely attractive in aggregate to advertisers. But these companies have to get over their natural aversion to sharing that data, or being worried that a little of my revenue is going to slip away to somebody else that's my friend and not my company. That helps. Others? Come on. Yeah. Here. Thanks.
Thank you. Hey, Richard. So you've named and shamed a lot of companies. Who's doing it well?
Well, I think there are many terrific premium publishers who are. I mean, if you take a look, actually, by the way, the New York Times stock price has done incredibly well this year, because they've started to turn that corner of the decline in their traditional print and publishing businesses and the rise in subscription and digital businesses. And I think that you are seeing, I think, hats off to The Guardian for taking Rubicon to task for ripping them off as their SSP. So I think you are seeing, and hats off to some of the things that the FT has done in terms of the way it's managing its own site. So I think you do see some premium publishers, admittedly that's not the long tail of the market, that are taking control back of their content. And look, Facebook and Google are doing phenomenally well. They've been great stocks, and they've been well-run, relatively well-run companies compared to a lot of other companies in the space. Whether it's, you look at Bing as a competitor to Google in search, and they just haven't measured up. So I think it's the companies that either have understood that this shift is going to happen and accepted it and moved on, or the companies that have been willing to give up on some of the dreams that they were chasing that we'd be more favorable about. I also think, another company, it gets a lot of mud thrown at it, but I think they've done a very good job, and it's a European company, is Criteo, which they're in a very simple space, which is retargeting. They arbitrage the fact that they can get much cheaper engineers in France than you necessarily can pay in Silicon Valley. They built a business where they're present in all three regions, and they can independently buy Facebook, Google, and other inventory. And that is valuable for a lot of people who don't want to just dump their CRM data into Google, Facebook, or Amazon. So I think there is a big role for independent players in this space. They just have to embrace the transparency. I think there's a big role for premium publishers. They just have to take back control of their content and not just sort of allow it to be resold by anybody and everybody, because they're chasing that last 1 cent CPM at the bottom of the waterfall.